Introduction. Do you know how much income your family gets and from which sources? Each family earns income by working in the agricultural, industrial or service activities. Meaning of public finance. Public finance deals with how a government raises revenues to meet its expenditure. Importance of public finance. The government's activities of mobilizing revenue, incurring expenditure and raising loans are part of its fiscal policy. The government usually spends the revenue collected through taxes or the money raised through borrowings for development activities. Budget. The government prepares and presents budget every year. In India, the financial year starts from April 1st and ends on the 31st of March of the subsequent year. The statement of estimated income and expenditure of a year prepared by the government is called budget. Budgets can be of three types: surplus, deficit and balanced budgets. Public expenditure. The expenditure incurred by public authorities like central, state and local governments to satisfy the collective social wants of the people is known as public expenditure. Promote faster economic development. Promote industry, trade and commerce. Promote agricultural and rural development. Promote balanced regional growth. Public revenue. Public revenue is the income mobilized by the government for purposes of financing the government's activities. The central government collects its income from various sources. Revenue receipts. The revenue generated by the government through taxes and non-tax sources is called revenue receipts. Tax revenue. Tax is described a compulsory payment by citizens to the government without expecting any direct benefit in return. The government imposes higher rate of taxes on high-income group and lower rate of taxes on low-income group. Direct taxes. When the tax is paid by an individual on whom it is levied, it is called direct tax. Indirect taxes. If the burden of tax imposed by the government is transferable to others, it is called indirect tax. Non-tax revenue. Apart from taxes, the government gets revenue from other sources. This is called as non-tax revenue. Profit earned by the Reserve Bank of India. Profit generated by the Indian Railways. Revenue generated by the Departments of Post and Telecommunications. Revenue generated by the public sector industries. Capital revenue. Capital revenue refers to those receipts which either create a liability or cause a reduction in the assets of the government. The government generates capital revenue through other sources too. Public debt, loans. The government borrows money from internal and external sources. The figure below shows the revenue and expenditure of the Government of India as per 2014-15 budget. Deficit financing. As studied earlier, the government first estimates its expenditure and then plans the revenue mobilization. In developing countries, public expenditure is usually higher than the public revenue. Fiscal deficit. the excess of government's expenditure over its revenue receipts and non-debt capital receipts is the fiscal deficit. Revenue deficit is excess of total revenue expenditure of the government over its total revenue receipts. Primary deficit is defined as fiscal deficit of current year minus interest payments on previous borrowings. Budget deficit is the overall gap between revenue and expenditure during a given year.